Hey everyone, welcome to Chapter 7, Internal Control and Cash. This is going to be the last chapter that we cover for the bookkeeping course, and there's two major concepts. I'm going to introduce a third, but there's two major concepts that we will be covering, and that's petty cash and bank reconciliations. But I am going to touch on internal control as it does affect cash directly and also comes into play when we're talking about petty cash. Okay, I think we all know what cash is, but cash is the most liquid asset. And what that means is a liquid asset means that it's easy to turn it into another asset. Okay. Um, since we use cash to purchase anything, that's why it's so easy to convert. And also, it's the most fraudulently misappropriated asset. If there's going to be a theft, it's most likely going to be cash over and above any other type of asset in an organization. And that's why it's so important to have a good accounting system in place to make sure that you know exactly where your cash is and that it's not being stolen, so to speak. So cash includes such things as actual currency, coins, amounts deposited in bank accounts, checking accounts, and savings accounts. There's different types as opposed to just currency. There's different types of checks, e-currency, and also cash is referred to when we're talking about an electronic funds transfer as well. Many companies actually, if they have more cash in their checking account, their main account, than what they need in the next, say, 30 days, a lot of companies to get the cash working for the company invest in short-term investments called cash equivalents so that they can earn interest instead of having the cash just sit there and not make money. So again, liquidity refers to how easily an asset is converted over to another asset. Okay, so control of cash. As you can imagine, it is so important in organizations to ensure that cash is being controlled. One way to do this is through separation of duties, and this is separate handling of cash from the recording of cash. So when duties are separate, it means that it requires two or more people to collude for cash to be stolen. But if there's only one person handling every step, say um, opening the envelope and getting the actual uh, check, going to the bank, depositing the check, recording it in the computer system, it's easier for the cash to be stolen that way. But if some of those items are separated between two or more individuals, it's less likely that it's going to happen. Also, cash should be deposited daily into your actual bank account. And this can reduce the risk of an employee personally using this money, say borrowing it for a couple of days until payday because they need the extra cash. And then making cash disbursements by check. So paying expenses by check or electronic funds transfer, which is done a lot. E-transfer is done a lot with businesses now. But if you're using a check, it is best to have two people have to sign the check to ensure that they are legitimate invoices that are being paid. One of the biggest ways that people steal cash, so to speak, is to pay fake invoices. Okay. So control of cash receipts. Internal control of cash receipts ensures that all cash received is accurately recorded and deposited. So again, two or more individuals should be involved with this process. And the important types of cash receipts, there's over the counter. So if somebody comes into your organization, whether it's a store or whether it's an actual business that sells things over the counter to individuals, or whether it's cash coming in or checks coming in through the mail. Okay, so over-the-counter cash receipts should be recorded on a cash register at the time of each sale. Custody of cash should be separated from its recording. So again, somebody that's in control of keeping the cash or controlling the cash register should not be the one that records the cash. And then, for example, an employee opening the mail should not be allowed to update the accounting records for the receipt of that cash. Cash over and short. So errors in making change are discovered when there is a difference between the cash in the cash register and the recorded amount of cash sales. This difference is reported as a cash over and short. And many of you, if you've worked in retail, have probably, or fast food even, are probably very familiar with having to count the cash in your cash register and compare it to the sales report. Okay, so when there is a cash over and short or short, it needs to be recorded. So there's an actual account, and we put it as an income statement account, as an expense account actually, and call it cash over and short, so that that's being tracked. It's so that it can be easily seen how much cash over and short has been going on in the organization, whether on a monthly basis or maybe even an annual basis. Control of cash disbursements. Control of cash disbursements is important, especially when considering, again, as I've mentioned before, that the easiest way or the most fraudulent way to that thefts happen with cash is the payment of fake invoices. So there should always be, when possible, a three-way matching to ensure that the the disbursement is legitimate before it happens. And that's why so many organizations use purchase orders. And then once the purchase order is filled and the item is received, there's a receiving report, and then the company is being invoiced. So if those three pieces of paper or systems can be matched up, then it's less likely that theft is going to happen. So separate authorization, check signing, and record keeping duties help to control cash disbursements. Okay, so at this point, I'm going to stop the video, and for the petty cash system of control, I will start a new video. Thanks, everyone.